Hello and welcome back to Crops TV. My name is Ryan Drollette. I'm a Farm and Agribusiness Management Specialist with Iowa State University Extension and Outreach. As we start off today, we're going to be talking about decisions for 2022 with the Farm Bill, crop insurance, and the cost of production. First of all, let's get started with Farm Bill, ARC, PLC, and some farm financial decisions as we think about it and how it relates to crop insurance. Right now, there is an opportunity for producers in the state of Iowa and across the United States for their program election for the Farm Bill programming, whether it's signing up for PLC, ARC County, or ARC Individual. Let's go ahead and get into this a little bit. So right now, ARC PLC Election Process, the deadline to sign up is March 15th. Each year from 2021 through 2023, producers have had and will have the opportunity to change the election on which program each farm is going to be signed up into. This is something that was new in previous years prior to 2021. Once you signed up, you were committed to that program for at least 5 years. Starting with the 2021 program year, individuals and producers could go in and change that election from year to year. Failure to make an election by March 15th of this year will result in a default to the current election that the farm is currently already in. Now, a reminder that all producers with an interest in cropland and the crop itself on a farm will make the election decision. Landowners do not make the election decision unless they are considered a producer or they have an interest in the crops that are on that farm. Otherwise, landowners are not involved in this election process. They can consult with the producer that's on the property, but ultimately the producer and the individual with risk in the crop that is on that farm is the individual who is signing up for the program. Even owners with an interest in CRP, that's a different story, and you can talk to your FSA office a little bit more about that. So PLC, ARC CO, ARC Individual. So I say PLC, ARC CO is ARC County, ARC IC is ARC Individual election. Elections of the PLC and the ARC CO or ARC County program are made on a covered commodity, based on covered commodity by covered commodity. So if I'm sitting with a farm number out in a county and I want to take my soybeans and elect them into the PLC program, and I want to elect my corn base acres into ARC CO, and I've got some wheat acres or barley acres, base acres that I've got, I can elect each one of those into the ARC CO or PLC program differently. If I'm in the ARC IC program, if I elect to enroll a farm into ARC IC, it is all covered commodities or all base acres of that farm are enrolled into ARC IC. I can't say, well, I only want the corn in the ARC IC and the beans into ARC CO or PLC. We can't do that. As soon as you say ARC IC or ARC Individual, all covered commodities, base acres on that farm get elected into ARC IC. But if I'm looking at PLC, ARC County, ARC CO, then I can do that based on each commodity differently. So let's start off with the price loss coverage or PLC program. This program, there's a national loan rate, a reference price, and then there's also with the current Farm Bill programming, there's the effective reference price. In this chart here, the effective reference price has been calculated to be the reference price that's listed above. So if I'm looking at the major commodities that are listed or that we have in the state of Iowa, corn, the reference price currently at $3.70, oats at $2.40, soybeans at $8.40, wheat at $5.50. The difference, you've got the national loan rate that's also listed on this chart, as you can see, and the difference between the reference price, the national loan rate, is the maximum PLC rate that an individual could get paid if a PLC payment gets triggered. If we get all the way down to $2.20 on the corn price, then a maximum payable rate would be $1.50 in that calculation. So right now on PLC program doesn't trigger unless those commodity prices go below those reference prices. So for corn, I'm going to stick mostly to corn and soybeans today. Corn 370, soybeans 840. I've got to get below these prices to be able to trigger a PLC program payment. So again, if I'm an individual, this is just a quick example on corn. If I have 100 acres of corn base on a farm and I elected into the PLC program, that farm has a PLC yield associated with it. For this example, 140 bushel per acre is the PLC yield. The effective reference price would be 370. The effective price is 330. So let's say that effective price is 330, meaning that the national average price for corn goes down to 370 or 330 for the year, the difference being 40 cents. So that means I would take my 100 base acres of corn, times it by 85% because I'm only getting paid on 85% of the base acres, times it by 40 cents, times that by the PLC yield of 140, and this individual in this example would get paid out $4,760. And I'm not, as you can see today, I'm not going through a lot of the calculations and the information on the PLC program. This program, PLC, ARC-CO, ARC-IC, these programs have been around for several years now. So I'm just going through some of the examples of what would trigger a payment and how much that payment might be. So as in the PLC example, if corn prices get down for the national average rate of 330, then I would have a payment made. I've got to be below that 370 to be able to trigger a payment in the PLC program. Corn 370, soybeans 840. Those are the two numbers that I want you to remember for PLC. Now, if you're sitting there going, well, how many base acres do I have on my farm and what commodity and what is the PLC yield? If you go into your FSA office, local FSA office for your county, and tell them that you want your 156EZ form, here's an example farm, Boone County, you'll have a farm number, who the operator is, how many base acres you have, and you'll notice that I've got here on this example farm, there's 80 acres of corn base, there's 70 acres of soybean base, for a total of 150 acres on this farm. The corn PLC yield is at 131 bushel, and the PLC soybean yield is at 41 bushel. Now these are the numbers that will be used to calculate the PLC, to be used in calculation of the PLC program. That every farm will be different. It all depends upon what your yield is and what your records state in your FSA office for whichever farm that you're looking at. Let's move on to the Agricultural Risk Coverage, or ARC-CO, ARC County program. This last year, payments were made. This was the 2020 crop that was harvested in the fall of 2020, and we call it the 2020-2021 crop because then it was marketed from the fall of price discovery, and marketing was from the fall of 2020 through the fall of 2021, after which payments are calculated and made and so on and so forth. So for 2020, this is the most recent payment that we have, payment information for the most recent crop, for the 2020 crop in the state of Iowa. These were the only payments that were made for any commodity, was for corn, and it was these few counties through the middle of the state of Iowa. The reason that payments were made on these counties was because of a low county yield that was reported, all due to the fact of a derecho that hit back in August of 2020. So all of the other counties within the state of Iowa, there was no payments made on either the ARC-CO program, ARC, or PLC programs. ARC individual, we're not sure because that's an individual thing, whether an individual triggered a payment or not. But for ARC-CO, we do know that these counties triggered payments, and we do know how much the payments were based on a county coverage and the formula that is used to calculate those payments. So let's get into an ARC-CO example. I've put together a few examples Based on even for those counties that triggered in 2020, 2021 is currently in the price discovery phase. So we're looking at, what the national marketing year average price is for corn and soybeans and all of the other covered commodities. But right now we're looking at 2022, the crop that we're going to grow in 2022. So I've got numbers listed here. This is Linn County. I've got the Linn County average yield. I've got the national average price, reference prices in there, and what it would take to be able to trigger a payment for the 2022 crop, what would be projected, right? So what I've done is I actually put in, so you've got all the calculations in there, and I'm not going to go through those in detail, but what matters is I've gone through and I've put in, I said, okay, what if Linn County has another countywide disaster in yield for some reason, somehow? Corn on the left, soybeans on the right. So corn, I put in 155 bushel. If you look at the derecho for 2020, that's pretty close to what the county yield was for 2020. So I'm projecting out 2022, and I said, okay, 155 bushel. Am I going to trigger a payment for ARC-CO for corn? And what my calculation says is if you look at that bottom graph on the left, bottom left corner for corn, the ARC-CO payment trigger becomes $4.64. So for Linn County, prices have got to get down to $4.64 and a yield of 155 before payments will ever be triggered for the ARC-CO program for corn, for my corn base acres. If I come in at 200 bushel to the acre, that price trigger becomes even lower because this is a revenue-based program. So higher yields means lower price to be able to trigger a countywide payment in the ARC-CO program for corn. So if I'm sitting there going, yeah, if I have an opportunity, or if there is a countywide yield issue that happens, I've got to get that price down to that 464 if I'm sitting at 155. Again, if I'm sitting at 200 bushel on the county average yield, then that price is even lower. Prices have got to get even lower than that 464 to trigger a payment. So if I'm looking at these programs, ARC-CO for corn, I've got to have a pretty low yield and a lower price than what I've currently got now. And you can look at those numbers. If I sit there and I go, well, at 370, 155 bushel, I might expect about $71 an acre. At 420 price and 155 bushel an acre, I might get down to that $25 an acre. So let's shift to the right side of that slide. I did the same thing for soybeans. You can see that I've got the year, the yield, the market year average price, and the reference price that will be used in calculating payments. You can see the 2020 yield, and for soybeans, the derecho didn't have as big of impact on soybeans as it did on corn. Corn, it blew everything down and laid it flat. Soybeans, not such the case. So as I look at a projected payment on soybeans, and I plug in 55 bushel on soybeans, then I'm looking at over an $8 price. I've got to get below that. 858 is my ARC payment trigger, ARC-CO payment trigger. I've got to get below that if I'm sitting at a countywide average of 55 bushel. And at 55 bushel, what price have I got to get down to? Basically what I'm saying is if I'm an individual looking at ARC-CO for my corn or my soybeans in Linn County, I've got to get a pretty low price and a pretty low yield to be able to trigger those payments. That being said, this is just an example on Linn County. So I went another county east, or west, I apologize. I went to Benton County, did the same thing as I did in Linn County, plugged in numbers and said, well, even without a derecho, what would things look like for corn? What would things look like for soybeans? I used 200 bushel in this case, looking at projected 2022 payments for corn. And so now then corn tells me if I'm sitting at 200 bushel an acre, I've got to get below 365 marketing year average price on corn to be able to trigger a payment on ARC-CO. If I go over to the soybeans, if I get a typical county average yield of 60 bushel an acre on soybeans, I've got to get below $8.10 market year average price to be able to trigger a payment on the soybeans. Now these examples that I put up are for Lynn County and Benton County. Each county is going to have a little bit different trigger price point and yield point because every county has a different yield. The marketing year average price is going to be used across every county, but the county yield is what is being used in the calculation. Every county's average yield is different, and so every county is going to have a little bit different price trigger, but overall it's going to be a similar scenario and similar story for each county across the state of Iowa and for majority of counties across the nation as well. As we look at, if you've got a county that's had fairly on-trend yields, you've got to have a pretty low county yield to be able to trigger a payment if we're looking at the current prices that we're looking at today in today's market. So let's move into the Ag Risk Coverage Individual, the ARC-IC program. So the ARC-IC program, again, I'm looking at revenue calculations based on all farms that are enrolled into the ARC-IC program across the state. It doesn't matter what county they're in, all of those get enrolled together. If I've got a farm that I'm farming in Scott County, Iowa, I'm also in Johnson County, Iowa, and I'm in Boone County, Iowa, and I've got them all enrolled into ARC-IC. It's going to take all of those counties, or all those farms are used together to calculate the revenue calculations and whether or not a payment gets triggered. Now, payments are dependent on planting the covered commodities on those enrolled farms. So if I've got only corn planted on all of those farms, corn is the only thing that gets calculated into the revenue calculation. If I have corn and soybeans, then corn and soybeans are used in the calculation of the revenue calculations and whether or not anything gets triggered. So there also needs to be established history of yearly yield reports that are required. I would say you need to visit with your local FSA offices about what history and county yields have been reported on those and what happens if you have a gap in any of those histories. Now, all of these, instead of using a county level yield and county level price, or market year average price, we're still using market year average price, but we're looking at the actual farm yield. That's why that is important, and looking at it based on all of those that are enrolled. So I put together an example of ARC Individual. This is Marshall County, Iowa, and I took an individual producer. I plugged in some yields. So the yields that are on there would be an individual producer. And I actually, because I didn't want to make this too far off of maybe what a county yield was, I put in county yields. But typically, an individual needs to plug in their individual yields into this calculation to figure out what would happen and what things need to happen to be able to trigger an ARC-IC payment. On this example, I've got corn and soybeans both planted on the farms that are enrolled. It's about, the ratio is 60% in corn, 40% into soybeans. I've got a yield of 185 on my calculation going, okay, what would trigger if I've got 185 bushel yield on corn and 57 bushel on soybeans, looking at the different prices, looking at 370 corn, 950 soybeans. If prices get down that low, then yes, I would look at probably triggering a payment of about $11 per base acre on the ARC-IC program. If I'm looking at a $4 corn price, $10 soybean price, with the yields that I've plugged in this example, then this individual would not be triggering a payment under the ARC-IC program. So ARC-IC, you've got to look through, what would the yield, what would trigger by yield based on pricing, based on what the expectations for market year average price is. Looking at the current market year prices, I'm not expecting very many ARC-IC program payments to be made either unless I've got a low yield. So right now, as I look at my programs, PLC, ARC-CO, ARC individual, I've got a decision to make. For individuals that are wanting to dig into the data a little bit closer and look at the spreadsheets, if you go to the Ag Decision Maker website, we do have spreadsheets, Excel spreadsheets that you can open up, download, open up on your local machine, and dig through the information, run some scenarios on your particular county, on your particular farms. PLC, it's pretty simple to sit there and say, well, if I believe corn's going to be below 370, maybe I want to look at PLC. Or maybe if I really do get below 370, maybe I want to be in the ARC-CO program. So maybe I'm going to look at the individual program. Really, it boils back down to your individual operation, what county I'm in, what my base acres are, and looking at what those things are and where I want to be and what things do I want to, what risk am I trying to cover, right? So again, remember PLC is triggered by that low prices. ARC-CO is triggered by the low crop revenue in the county. ARC-IC is triggered by low operator farm revenue across all crops and farms enrolled in the IC program. One other thing that you want to think about is, am I looking at purchasing a new, well, it's fairly new, but it's been around for several years now. If I'm looking at purchasing the SCO endorsement on my crop insurance. Now, if I'm looking to sign up in the ARC-CO or ARC-IC program, I am not eligible to purchase the SCO crop insurance endorsement to my YP or RP crop insurance. So that's another thing that you've got to think about. But when I'm looking at it right now, the decision truly is, what thing do I want to insure against? Do I want to insure, do I have a risk about, do I want to insure the risk on a low price? Then looking at PLC is probably the program that you want to look at. If you want to insure that 370 corn, 840 on soybeans. If you want to insure a county revenue, then if you want to insure against the county revenue going low, and at the moment, if I'm thinking that prices are going to be high, I'm looking at the county yield, and I look at insuring, well, a major catastrophe like the derecho in 2020, then I look at maybe the ARC-CO or the ARC-IC for my farm, okay? But if I'm in ARC-CO or ARC-IC, and I'm thinking about SCO, I can't buy that SCO. So that segues me into, let's looking at some of the crop insurance decisions that we have. So SCO or supplemental coverage option is an endorsement to your current federal crop insurance products, whether it might be a yield, an YP, yield production, revenue production, or revenue production with harvest price exclusion. Those are the underlying policies. SCO or supplemental coverage option is an endorsement on top of those current federal crop policies that I've already got in place. So SCO covers part of the deductible based on county yields and county revenues, and depends on what underlying policy that I'm enrolled in. You purchase SCO from a crop insurance agent, and 65% of the premium is subsidized by the federal government. SCO cannot be purchased for farms that are in that ARC program, ARC-CO, ARC-IC. I've said that before. And if I've purchased SCO, it has to be for all of the planted acres in the county that I'm in. So if I'm in the PLC program and I've got corn and soybeans, I've got to purchase it for all of those PLC program farms farms that are in ARC CO, ARC IC, those are not enrolled. So if I've got several farms within a county, I can purchase, and I'm enrolled in PLC and ARC differently for different commodities. I can purchase that SCO for those farms that are in the PLC program, but not for the ARC and ARC CO program. And as we look at whether or not I'm going to get a payout on the SCO program, the actual 2022 SCO yields will not be published until June of 2023. So realizing that the ARC program will pay out for 2022 in October of 2023, SCO will pay out June of 2023, and typically my federal crop will pay out after I've got price discovery in the fall and I know what my yields are and I've reported them, and they'll typically pay out a lot quicker than SCO will. So if I'm looking at SCO as a crop insurance endorsement, realizing that those yields won't come out until June of 2023, and then payments will be factored in at that point in time. So another product that we want to look at today for federal crop insurance is ECO, or Enhanced Coverage Option. It is also an endorsement to my current YP, RP, or my RP policy with harvest price exclusion. ECO cannot be bought and purchased on area. If I've got an area policy, I cannot buy an ECO endorsement onto that policy, but I can if I'm in RP, YP, or RP with a harvest price exclusion. So ECO will cover from 86 to 90% coverage level, or 86 to 95% of my underlying policy. And the deductible is based on the county yields and county revenues. I'm also purchasing ECO from my crop insurance agent. There is a subsidy on the premiums for those as well, but it depends upon which if I've got an RP policy or a YP policy. It's not this ECO is not restricted to the ARC PLC election. So if I'm in ARC CO, ARC IC, or if I'm in PLC, it doesn't matter. I'm not restricted. I can purchase this for the commodities and farms that I've got enrolled in the ARC CO or ARC IC. It can be stacked with the SCO, but it's not required. I can buy it with SCO or without. The ECO yields are also the SCO yields. So if purchased for all acres in the county, realizing that I'm not going to have those yields published until, again, June of 2023. So this is my example with my chocolate milk. I do chocolate milk. I love chocolate milk. Not much of a coffee drinker. So today, this is my chocolate milk, glass of chocolate milk. I've got my underlying policy, and this is just an example. If I have an RP policy at 80%, in this quick example, I'm sitting there going, you know what? I've got my farms enrolled into the PLC program. I'm going to buy SCO on top of that, and SCO covers me from 80% up to 86% coverage level. Another example I've got here on my other glass of chocolate milk, I've got my coverage level again, my RP policy at 80%. I chose not to buy the SCO policy, and so then there's that gap from 80 to 86. ECO can be bought on top, and again, that goes from 86 to 90%, or 86% to 95% is my coverage levels on the ECO policy. Or a third cup of chocolate milk says I buy revenue protection up to 80%, I buy SCO up to 86%, and I buy ECO up to 90 or 95%, however I want to do it. So I can stack them, I can buy one or the other, or none at all. So this is just examples of coverage levels in which I can use to stack my revenue protection, SCO, and ECO. This is still early in the spring. We're sitting here in January of 2022 at the moment. I don't have spring prices for 2022 yet. We won't know those until the end of February, 1st of March. So I'm looking at, the best I can do on examples is looking at the spring prices for 2021. Spring prices for 2021, corn was at $4.58, soybeans were at $11.87. Looking at an 80% coverage level, 200 bushel corn, 60 bushel of soybeans, taking that $4.58 times 200 bushel times 80%, my revenue protection policy says that I'm a minimum guarantee of $732.80 on corn. Beans, if I had $11.87 for that spring price, 60 bushel was my my covered policy level at 80%, 569.76 was my minimum guarantee with a revenue protection policy for corn and for soybeans. And I'm going to use these numbers in some of the examples as I move forward here, but realizing this is not current prices or premiums. This is spring 2021, so I'm looking at 2021 example here as I'm looking at it. As we hit the 1st of March, you can talk to your crop insurance agent. They'll give you updated numbers as we know what the spring price is looking out. So this is data that I pulled. This is a farm doc from the University of Illinois program and spreadsheet that I went in, and I can plug in my, if I'm looking at an RP policy, if I'm looking at enterprise or individual units or farm units or whole farm units. So in this example, I'm looking at Marion County. I did an RP policy. I did enterprise units, and I'm looking at, this is at corn, non-irrigated. What would the premium have been for SCO, ECO, and combine that with an RP policy, right, at different coverage levels? If you look at maybe an 80% coverage level for Marion County, if I was buying just my RP policy, that would have been $19.02. If I bought ECO up to, or let's go back to SCO. If I'm at 80% coverage and I want to bump my coverage up to 86% with SCO, that premium would have cost me another $646. If I then want to stack on, if I'm looking at ECO, up to the 90% coverage level in Marion County would have cost me $9.28. And if I would have gone up to the 95% coverage level, I would have had a premium of $23.69. So then the far right of this chart says, okay, RP policy, 80%, 1902. If I start stacking on the SCO, ECO, SCO and ECO up to 90%, SCO and ECO up to 95%, or just my RP policy with ECO 90%, 95%, what would the total cost be for each of those being stacked on top of each other? So RP with SCO, ECO up to 95% at 80% coverage would have cost me just shy of $50 to cover corn in Marion County last year on those premiums. Now, if I was looking at an 85% coverage level, stacking ECO up to 85, or stacking the SCO up to 86 and the ECO up to 95%, I'm looking at over $60 premium that it would have charged, that I would have been charged for that policy with those endorsements on there with the SCO and ECO. Every county is going to be different. Here's an example, same thing with Mahaska County, looking at enterprise units, plugging in what a typical farm in maybe Mahaska County would have, and looking at what those premiums would have been for SCO, ECO up to 90% coverage or up to 95% coverage, and what each of those stacked on top of each other would have been. And you can go back and say, well, Marion County, I look across the bottom there, the most expensive policy, if I had been 85% RP with ECO up to 95% and SCO, I would have been just a little over $60. Mahaska County, a little bit different. If I had my RP policy at 85%, SCO, ECO all stacked together, My highest premium looking at it was just over $35. So looking at, what level of coverage do I want? Am I currently sitting at 85% coverage? Do I want to back down to 80% coverage on my RP policy, buy back up with SCO to 86%? Do I want to then add on and go up to 90 or 95% with ECO? What those premiums might be is all county by county and based upon what your trend adjusted yields are for your current policies. And these are things that you can go in and look up. You can download this program from the University of Illinois from FarmDoc, plug those in, or you can hit up your crop insurance agent and they'll be able to plug those through for you. But again, that won't be available until, for the current year, until after we have gone through the spring price discovery in February, end of February, 1st of March is when we'll know what those premiums will be. But the decision that can be made is looking back at previous years, do I want to cut back on that RP policy or my YP policy coverage, buy up on the SCO and the ECO and have a little bit more coverage. Now, the SCO and ECO are more of an area-wide policy, not individual policies. So just for sake of getting a little bit further west in the state, here's an example with Boone County, again, enterprise units. You can go through the spreadsheet and go, well, do I want to be in enterprise units? Do I want to be in individual units? And looking at what would the cost be for my RP policy last year if I would have bought up the ECO and the SCO. Getting even further west across the state, here's Cherokee County and the examples for Cherokee County. Most expensive, 85% RP policy with SCO and ECO up to 95%. I'm looking at just shy of $50. So I'm at just a little over $47 per acre on my coverage for corn. So this is just the example that every county is going to be different. You need to look at it based on a county per county basis, what your current policy is, and then whether or not you want to buy up with those area policies, those add-ons with SCO and ECO. And then what level of ECO do you want to add up to? So if I'm interested in SCO, ECO, consult with your crop insurance agent. They're going to be able to help you walk through some of those decisions. It does require paying the premium for SCO and ECO. County yields, if I'm sitting there going county yields are moving in opposite direction of my farm yields, then it's not going to work the same as my RP policy. A lot of these, if I'm looking at SCO and ECO, we look at them and say, did the county yields move in the same direction as my farm yields move? If so, it might be something I want to look at a little bit more closely. If they're moving opposite directions, if my farm yields move in an opposite direction as the county yield, then I might want to look at it a little bit more closely and decide if this is the coverage that I really want to have in place, because these are more of an area coverage type insurance products. Now, payments are triggered, also realizing if I'm interested that the payments, if triggered, won't be until after yields are calculated, and those won't be until June of the following year. I don't have to buy that SCO if I want to buy ECO or vice versa. If I do purchase that SCO and I've enrolled farms into the ARC program, I've got to go back to the FSA to cancel policies or face a penalty. So realizing that SCO is dependent on being enrolled in the PLC program, ECO, it doesn't matter what farm deal program I'm enrolled in. So some of the websites I'm going to push you to look up more information. Again, ISU Ag Decision Maker, and also your USDA FSA office and your local FSA staff. So those are the websites that you can go to. Ag Decision Maker, you can go into the Farm Bill, information on the Farm Bill, pull out the payment estimator, play with the numbers, look at your counties, and decide what you want to go from there. Also, there are other universities, extension universities, that have information on Farm Bill and programming and what those payment calculators might look at. You can go to FAPRI with the University of Missouri. There's FarmDoc with the University of Illinois. and also Texas A&M, and also North Dakota State University also had a ARC individual calculator out there at one time, and you can pull that up and use that if you'd like. Also, if I'm looking at something other than corn or soybeans, Ag Decision Maker, we've only done corn and soybeans. If you're looking at oats, if you're looking at barley, if I'm looking at sunflowers, I've got to go to Texas A&M or FAPRI, more than likely Texas A&M, where I might go to use their decision tools. So let's get into crop budgets for 2022. So the current estimates for crop production costs they're out, they're fresh off the press. But before I get into that, I want to sit there and go, as we sit there and think about our cost of crop production, a lot of us have seen graphs like this one, where we're looking at the average weekly retail price of anhydrous ammonia. This graph here showing from DTN showing the previous 2 years. Well, we've got the current year we're in right now as it finished out 2021, 2020, 2019. So those prices in there in the 5-year average. And currently anhydrous and fertilizer prices across the board are significantly higher than what they have been the prior 5 years and even over the 5-year average. And you can take this graph, you can look at DAP, you can look at potash, you can look at any fertilizer input, and it's going to look very similar. So this is the USDA marketing report out of Des Moines. This is the most recent one before this recording, but as you sit there and you look at some of those prices for farm fuel, propane, urea, anhydrous ammonia, that's where the current prices currently are at the moment. They have kind of leveled off. They're not on that sharp incline as they had been through the fall. But one thing that I do want to pull everyone back just a little bit, I went through the USDA NASS data and pulled up USDA the fertilizer index prices for mixed fertilizer. And this is from January of 1990 all the way through November of 2021. And the index is based in 2011. So 2011 is my index of 100. And based upon the index, I'm getting close back up to, based on a 2011 index, to my fertilizer prices. We've had some really good, lower fertilizer prices for the last several years, but based on the index, I'm still not back up to 2011 proportionately, or even if you look further back when prior to 2011, or 2008, 2009, where fertilizer prices were significantly higher. So yes, we do have some high fertilizer prices as we look into the spring. Have we been higher? Yes. Have we been lower? Well, of course we have, as we're coming off some lower prices the last several years, and now it looks like we're moving into some higher prices on our fertilizer. So yes, fertilizer prices are up. Are they as high as they've been? No. There's still room to go up as we look at it. So now let's get into the cost of our crop production. In these numbers here, this is Iowa State numbers, survey numbers that have been compiled and put together. So what I actually did, this is the corn following corn, and I took out the land costs. Typically, we would put in there what the cash rental rate for the state was at that given time or that given year. I went in, I took out the land costs. I'm not in the interest of setting cash rental rates and telling everybody what my projections are on cash rental rates. That survey comes out in a few more months. But as I looked at 2021 versus 2022, for corn on corn, I looked at 2021, we're at 481 cost per acre. And if I'm looking at 184 bushel an acre, came out to about $2.62 a bushel, not including the land costs, 2021. I go up to 2022 with the projections that we've just published, and they're out there right now on the Ag Decision Maker website. I'm looking at $609 with no land costs in there. Based on 184 bushel an acre, that puts me at $3.38 per bushel. And And you can look at the breakouts from machinery, fertilizer, seed, labor, insecticide, pesticide, and the other costs and miscellaneous as well. The other has my crop insurance premiums. It has other miscellaneous items in there, and my interest that I've got on any borrowing that I've got in the spring through that crop year. Okay, so machinery costs up, fertilizer, of course, they're up. Labor, we've added that one up as well. Seed costs are up. Everything is up across the board. So corn following corn, without the land cost, I'm at $3.38 at 180 bushel. Corn following soybeans, 2021 costs there on the left, 2022 costs there on the right. And again, I'm going to state, as we're looking at these, this is a state average cost. This isn't what your individual farm is. I would say that this is the state average cost on the surveys that we've taken every year to determine what are the average costs of production across the state of Iowa. So 2021, I'm looking at $442, so an average of $2.20, looking at based on 184 bushel an acre. 2022 projections, $553 an acre. That's based on 198 bushel an acre. That's $279. And you're probably sitting there screaming at me going, Ryan, why are you at 198 bushel versus 184 bushel? And on the previous one, you had 180 bushel, 184 bushel. Bear with me here. We've changed some methodology in pulling the cost of production numbers together, going back to the nitrogen rate calculator that Iowa State helps and puts together on the crops team, and what is the current rate of nitrogen we should be putting on based upon current price and based on cost. What would that yield be? And that's where we've started pulling that back into that cost of crop production. What is the nitrogen rate? What is the fertilizer rate? What is the expected bushels that I would expect based on those nitrogen rates? So even though my bushels are different, I'm also changing my fertilizer rate as well based on cost of fertilizer, cost overall. Machinery prices are up, $125 to $145. Fertilizer, lime, $113 is what I would probably expect on average last year. On average this year, I'm going to expect about $176 on the cost per acre. Seed, $98 an acre to $106 an acre. So all of my costs are up and up significantly. And remember too that this does not include any land costs. So then I'm going to look at my soybeans. Soybeans costs up as well for the 2022 projection. Again, non-land in here. So $279 based on 56 bushel an acre. That puts me at an average of $498 per bushel costs for last year. This year at 2022, looking at the increased costs that are that we've got on the survey and the individuals reported, overall cost of $342 per acre at 57 bushel an acre comes in at $6.02 per bushel. So all of those levels are up, again, not including any of my land costs. So then I want to factor in and think about land cost. What am I paying in cash rental rate, right? So if I'm looking at, and this is an example, I put together the what if scenario in an Excel spreadsheet. What if corn prices, my two variables, price of corn, what is my yield, what can I be paying for cash rental rate, or what am I paying for cash, I can look at it as what am I paying for cash rental rate, or what can I be paying and what money will I have left over, or I can look at it, this is what I'm paying in cash rental rate, am I going to have any money left over? So you can look at this in several different ways. So based on these charts, the numbers within the charts don't change. It's the red area that changes based upon the cash rental rate that I've got plugged in. So if I've got $200 an acre rent, if I've got $250, $300, $350 dollars that I'm paying for rent, I can look at my expected market year average price that I'm going to receive at the farm level and what my farm level yields were. And if I'm looking at a $5 corn price and I'm looking at maybe 190 bushel, am I still going to be having, am I going to be able to cash flow based on 200 an acre rent or based on 300 an acre rent or 350 acre rent? So you can look through those charts and sit there and go, well, what am I paying in cash rent? What am I expecting that farm price level to be? What is my yield, average yield across the farm going to be? Am I going to be making any money based on this and also based on those cost of production numbers that I've got in those previous numbers, okay? This is also for soybeans, looking at the same thing, going, what is my expected yield? What is my expected farm price that I am going to market my soybeans for? What am I paying in cash rental rate? Am I paying 200? Am I paying up to 350 acre rent? You know, am I still going to, based on my average costs, am I still going to have am I still going to be able to cash flow this coming year? So this chart here, I looked at 400 an acre rent for corn, for soybeans, and then at the top chart there, I put zero rent in there. You know, what type of return would I expect with average cost of production numbers that have already been, that I've shown you in the previous slides? You know, how much am I expecting to return with no rent, or maybe my most extreme rent of $400 an acre rent, based on also what my expected farm price would be and what the yield would be expected at the farm level. So then that pulls me back into some of the farm finances. You know, our accrual net farm income in the past 2020, I expect when we get 2021 numbers, the numbers will look fairly similar to 2020, if not maybe even a little bit better. We had several years of low accrual net farm income. 2020 was a lot better. 2021 hopefully was also as good as well. As we look at those numbers, we're coming off you know, a few good years the last several years. And as I look at the current ratio and the average liabilities of Iowa farms over history, and the numbers that I'm pulling this from is from documents off the Ag Decision Maker. So I'm looking at that current ratio number. Current ratio came down from 2012. We were sitting at 14 through 2020 at that current ratio being right around between 2 and 3. So not too bad, but my liabilities, whether they were short-term, medium-term, long-term liabilities, had increased from 2012 into 2020. So looking at the current farm financial situation, liabilities, you know, not, you know, are higher than what they had been in 2012 and 13 when they had risen. Current ratio kind of being stable between that 2 and 3, and also looking at our distribution of working capital per acre based on years from 14 to 2020. So again, we're hoping, you know, as we look at getting 2021 numbers in, you know, how does that change these ratios? And you can see in 2020, that higher distribution of working capital being in that green, so a little bit better on working capital in the last year. So hopefully this coming year, as we look at what program you're going to sign up to, what crop insurance, what risk you want to cover with your crop insurance, and also thinking about what your current farm level costs are. Again, we've shown you averages across the state, you know, but what is your current cost of production numbers? What are the things that you want to cover with your crop insurance? What risks do you need to cover, and how much of it do you need to cover? And then also, as that pulls then back into, as you go in and elect what farm program you're going to elect. Am I going to be in the ARC County, ARC IC, PLC programs? How does that play back into what risks do I need to cover at my individual farm level? I'd like to thank you for your time and hope you enjoyed this presentation, and good luck this coming year.